So when I've looked at all the investors of very large reputations, Warren Buffett, Carl Icahn, George Soros, they all only have one thing in common. And it's the exact opposite of what they teach in a business school. It's they make large, concentrated bets where they have a lot of conviction. They're not buying 35 or 40 names and diversifying. I don't know whether you remember, Icahn a few years ago put $5 billion into Apple. And I don't think he was worth more than 10 billion when he did that.
Right.
When I went in to tell Soros that I was going to short 100% of the fund in the British pound against the Deutschmark, he looked at me with great disdain because he thought the story was good enough that I should be doing 200%, because it was sort of a once in a generation opportunity.
Right.
So A, they concentrate their holdings. B, concentration, this is very counterintuitive. It really gets your attention. So it actually, in my thinking, decreases your overall risk, because where you tend to be in trouble is if you have 35 or 40 names and you stop paying attention to one. If you have big, massive positions, it has your attention.
Right.
So the way my favorite quote of all time maybe is Mark Twain, put all your eggs in one basket and watch the basket carefully.
Right.
I tend to think that's what great investors do. The other thing to me is you got to have to know how and when to take a loss.
Right.
I've been in business since 1976 as a money manager. I've never used a stop loss, not once. Dumbest concept I've ever heard. It goes down 15%, I'm automatically out. But
Right.
I've also never hang on to a security if the reason I bought it has changed. And that's when you need to sell. If I buy X security for A, B, C, and D reasons, and those no longer are valid, whether I have a loss or a gain, that stock doesn't know whether you have a loss or a gain. It is not important. Your ego is not what this is about. What this is about is you're making money. So if I have a thesis and it doesn't bear out, which happens often with me, I'm often wrong, just get out and move on. Because I said earlier, if you're using a multi-disciplined approach, you can find something else. There's no reason to hang on to any security where you don't have great conviction in it. Look, I'm not going to lie to you. My first boss had this saying, the higher they go, the cheaper they look. There's something weird, and I know everybody watching this has experienced this, and it doesn't make any sense, but when a security goes up, every bone in your body wants to buy more of it, and when it goes down, you're fighting making yourself not sell it.
Right.
It's just the nature of the beast. And you have to constantly remind yourself why you own that security. And just because it's going down doesn't necessarily mean you should sell it. If it's going down, it definitely means you should reevaluate your thesis, but it doesn't mean you should sell it. And you cannot get crazy when it's going up. One of probably the biggest mistake I ever made in the business, and I knew better. Somebody asked me what I learned from this. I said, nothing, I already knew it. In January of 2000, after riding that tech boom to a T and making billions of dollars in 99, I sold everything out in January. And I had a couple of internal portfolio managers at Soros who didn't sell out, and they had it was a smaller portfolio, but they made 30% after I sold. And I just couldn't stand it anymore. And I'm like watching them make all this money every day. And like for 2 days, I'm like ready to pick up the phone and buy this stuff back. And there's a little devil there, and then the angel, and she's saying, don't do it. And he's saying, buy it. And I pick up the phone and I buy them. I might have missed the top of the .com bubble by an hour. I ended up losing $3 billion on that trade alone. I had made more the year before, but $3 billion is a lot of money. And it was all because I got emotional and dropped every tool of discipline I've ever had. And somebody says, well, what did you learn from it? And I just said, I learned nothing. I learned that 25 years ago. So you can talk about not being emotional, but it takes incredible discipline to act on that. But the fixed income market has become much more complicated. And I'm lucky enough, since I play in a lot of asset classes, to have the luxury of not playing in one. And I don't think I'm going to be playing much in that one going forward. The currency market is incredibly interesting to me. I haven't been doing much there, and I'm not currently positioned aggressively there. But I will be surprised if sometime in the next 6 months I'm not short the dollar. $14 trillion has come in here because we were the first to tighten. There's a story about American exceptionalism. I'm not sure we're so exceptional anymore, and if we are, I'm not sure I'm excited about what we're exceptional in. So foreign exchange looks interesting. We still own energy and other commodities. Ukraine sort of gave that trade an extended life, although I must say the energy, because of the transition to ESG, we look to be short energy for 5 or 10 years, so that could last a while.
It's so interesting to hear you talk about this stuff because you so fluidly move between all these different asset classes. And one thing that makes me think of is crypto. Obviously, you've done kind of a little bit in crypto before. I remember you saying that it's just hard to get the size of position that is interesting to you in crypto. One thing I was wondering, are you seeing crypto start to affect other asset classes and other currencies?
I don't know whether I'm seeing it, but I expect it to. You can't build over 2 trillion in wealth in purchasing power and then take 1 trillion of it out and not matter. John, I also have high frequency signals, and there certainly seems to be a strong correlation between crypto and the NASDAQ. I don't think it takes a genius to figure out why. So I'm looking at it as an indicator that way. Crypto, everything that Charlie Munger says about it, I'm sympathetic to. Everything that says Bill Miller says about it, I'm sympathetic to. So I think that's a movie that has yet to be played out, and one that I don't want to bet on in conviction, but I will be very surprised if blockchain isn't a real force in our economy, say 5 years from now to 10 years from now, and not a major disruptor with companies that will have been founded between now and then that'll do very well, but that will also challenge things like our financial companies and do a lot of disruption. So I find crypto interesting. My 69th birthday is in a couple of weeks. I'm probably too old to compete intellectually with the young people in this space, but I'm certainly monitoring it.
I was going to ask that. Do you think younger Stan would be kind of diving into crypto more energetically?
I think a younger Stan would be diving into everything more energetically than I'm talking to. Age is a funny thing. I feel my predictive power and forecasting power is as good as it's ever been the last 3 to 5 years. I'm certainly not making 30% net returns per year like when I had clients. So I think it's two things. Yes, I think younger people understand new asset classes better. But B, I'm just not playing anything as aggressively as I used to.
I want to get back to that because that's interesting. But one other crypto-related question, as I think about Bitcoin, the closest analog is clearly gold, and people talk about digital gold, by which I mean if you want to remove yourself from cash, if you want to be independent from inflation, your government in whichever country you're in, traditionally gold would be the asset that you would kind of pull back into. Nowadays, that can be Bitcoin. And so you'd expect their cyclicality to be similar, and yet Bitcoin is highly cyclical, gold is counter-cyclical historically. Why is that?
I'm not sure why, other than NASDAQ type risk play takers are the ones that tend to play in Bitcoin, and curmudgeons that are gold bugs and want the world to fall apart playing gold. But there's no question, and this I've watched, and it's gone on long enough now that I believe it, that if you believe we're going to have irresponsible monetary policy and inflation going forward, if it's in a bull phase, you want to own Bitcoin. But if it's in a bear phase for other assets, you want to own gold. And I think I just articulated the reason, but sometimes, John, I don't care. This has gone long on enough that I'm starting to believe what I'm observing. And for sure, if I think we're going to have an inflationary bull market, I'd want to own Bitcoin more than gold. And if I thought we're going to have a bear market, stagflation type thing, I'd want to own gold. Doesn't mean I'm going to believe that in a year, but that's my assumption going forward from this point.
And is that because of some fundamentals of the underlying assets, or just based on what you've observed in their behaviors to date?
It's 85% what I've observed, but I would also say it's the type of investor. Over-the-counter FANG type investors, if they believe in inflation and they tend to be younger, they want to play Bitcoin. Old curmudgeons that secretly want the world to fall apart, they don't own Bitcoin, they own gold. So, but that's kind of cheating, because that's kind of a reason I've made up for what I've observed. I think you gotta know your own biases.
Yes. Going back to how you work and, kind of the young man's game and things like that, I talked to someone who worked for you who said maybe an underrated aspect of your performance historically is you just work way harder than everyone else. And there's few people who have been in the market since the 70s working with your work ethic and, across such a broad range of assets. How relevant do you think that is, or how much truth do you ascribe to that?
I think it's very relevant. I was pretty lazy in college, and I never considered myself a particularly hard worker, but I'm so passionate about our business that it's almost like a compulsive gambler that has a way to channel his compulsive. And the fact that every event in the world affects some security price somewhere, and the fact that I'm so intellectually stimulated trying to imagine the world 12 to 18 months from now versus the way it looks in the present, and security prices, how they would reflect that. I just find it so stimulating. It makes everybody think I'm a hard worker because I'm attracted to the game. So in this game, I am a hard worker, but I actually think there's a life lesson there. I've seen young people who, when they find their passion, who had kind of looked like they were lazy or lost their way or weren't very driven, become very driven. I just happen to be passionate about this particular discipline. So I don't know whether I have a hard work ethic, but that's the end result of my passion.
Are you then excited about the growth of mobile investing and approachable retail investing for kind of a younger crowd because it might pull more people into this, or do you think it might get people in for the wrong reasons and it's a bit more of a blinking slot machine game?
The latter. I mean, given what's going on the last 11 years with central bank policy and the breadth of the bubble, I do fear for, one of the sayings, I'm sure you've heard it, but I probably heard it the first week I was in the business 50 years ago. It still applied. Bull market geniuses. I think there's a lot of bull market geniuses around, and it's not that they love the game, they love winning, but they were surfing with a hurricane behind their back that was giving them these nice waves. They may become very discouraged. So I don't embrace, I've heard a lot of people embrace the fact that all these people are investing now in all these and how great it is. I don't think it's so great if the story doesn't end well.
Yeah, and certainly we may see an interesting scenario play out over the next year or two. Going back to your style, the other thing I found very interesting in how you work is this, your philosophy of put all your eggs in one basket and then watch this basket very carefully. And you've described how you just develop conviction 3 to 4 times a year and act based on that. And I'm curious if you could talk a little bit more about that, like the spidey sense going off, and you're clearly in a low conviction time right now, but I think that's just very stylistically interesting, where you even know how to size up and down your trades.
Yeah, it's completely contrary to what they teach in business school, which is if you're highly diversified, you have less risk than if you're highly concentrated. I don't believe that at all. As an investor, when I think most people get in the most trouble is when they have stale longs or stale shorts. When you've got 15, 20% of your asset base, or sometimes in macro positions, I'll have 200 or 300%. Believe me, they're not getting stale, and you have to have ruthless discipline, and you're coming in every day. Just to quote Andy Grove, you could not be more paranoid, and you're constantly reevaluating, and I think it leads to an open mind. So, yeah, I would also say people ask me what I learned from George Soros. I thought when I went there I was going to learn what made the yen and the Deutschmark go up and down and that kind of thing. No, what I learned was sizing is probably 70 to 80% of the equation. It's not whether you're right or wrong, it's how much you make when you're right and how much you lose when you're wrong. I've also found as an investor, I believe in streaks. You see it in baseball, you see it in everything else. I see it in investing. Sometimes you're seeing the ball, sometimes you're not. One of my number one jobs is to know whether I'm hot or cold. And when I'm hot, I'm supposed to turn the dial way up, not say, okay, I'm up 40% this year, let's go, this will look good at the end of the year, go take a break. No, you got to make hay while you're hot. And then when you're cold, the last thing you should do is try and make big bets to get back to even. You should tone yourself down. So believe it or not, that's part of the all your eggs in one basket.